I'm going to be walking through how to do short exercise 6-5, but before I do that, I want to hit on a couple principles that you should read about in your book, but I want to call special attention to them. First of all, when we talk about the underlying generally accepted accounting principles for inventory, one thing that we're talking about those accounting principles is disclosure. The disclosure principle means that a company's financial statements should report enough information for outsiders to make informed decisions about the company. So that's one accounting principle that is relevant to inventory. The next principle relevant to inventory is representational faithfulness. The company should also report relevant and representationally faithful information about itself. This means properly disclosing inventory accounting methods as well as the substance of all material transactions impacting the existence and proper valuation of inventory. And finally, the other principle, accounting principle relevant to inventory, is consistency. It also requires the use of comparable methods for consistency of presentation from period to period. The financial statements typically contain a footnote describing the inventory pricing method used, as well as the fact that the inventory was valued at the lower of that method or market. The lower of cost or market rule is what we're going to be talking about next in the next slide. Without the knowledge of the accounting method and without clear, complete disclosures in the financial statements, a banker can make a bad lending decision. We refer to the lower of cost or market rule. It's abbreviated as LCM. It's based on the principles of relevance and representational faithfulness. LCM requires that inventory be reported in the financial statements at whichever is lower, the inventory's historical cost or its market value. Applied to inventories, market value generally means current replacement cost. That is, how much the business would have to pay now to replace its inventory. If the replacement cost of inventory falls below its historical cost, the business must write down the value of its goods to market value, which is the most relevant and representationally faithful measure of its true worth to the business. The business reports ending inventory at its lower of cost or market value on the balance sheet. Okay, so let's do just a quick little question about this, see if you can digest that. The lower of cost or market rule requires a company to report inventories at the lower of what? A, historical cost or current sales price. B, historical cost or current replacement cost. C, current replacement cost or sales invoice price. Or D, FIFO cost or LIFO cost. So take a minute, see if you can answer that. The answer is B, historical cost or current replacement cost. That is the lower of cost or market. Those are the two values, and the company is going to report at the lower of those two values. Okay, so now we get into short exercise 6-5. And this is an application of lower of cost or market rule. On short exercise 6-5, it's December 31st, the end of the year, and the controller is applying the lower of cost or market rule to inventories. Before any year-end adjustments, here's their data. They have cost of goods sold of $380,000, and the historical cost of ending inventory as determined by a physical count is $56,000. The company determines that the current replacement cost of ending inventory is $52,000. Show what Raney should report for ending inventory and for cost of goods sold. Okay, this one is not bad. This is a quick exercise. First of all, we're going to compare the historical cost of inventory, which is $56,000, with the current replacement cost, or the market value, $52,000. So ending inventory is going to be valued at $52,000 because $52,000 replacement cost or market value is less than its cost, and we're going with the lower of cost or market. And ending inventory is an asset, and it appears on the balance sheet. So that's how we would say, that's answering how we would report ending inventory. Now the other thing it asks for is how we would do cost of goods sold. Well, cost of goods sold is going to be $384,000. How did I get that? Well, I'm going to take the $380,000 that they gave us in the table, So that's the unadjusted cost of goods sold. And then I have to adjust for the lower of cost or market adjustment. We said that our historical cost was $56,000. The inventories actually were $52,000. So we have kind of like a loss of $4,000 on it. So we're going to add that loss, because that loss is an expense. A loss acts like an expense. We're going to add that to our cost of goods sold of $380,000. So that's how we get to the $384,000. The $380,000 cost of goods sold unadjusted from the table, plus the loss that we took when we adjusted the inventory from historical cost down to market. Okay, and that's it on short exercise 6-5.